We are going to wrap up today, though, with a look at Ceres Power. Mark, this is a company which provides fuel cell technology, the details of which we may or may not get into in a moment, but it's been around a long time. It's had its ups and downs, certainly more downs than ups recently. The interim results were perhaps of a piece with that because they were a little bit disappointing.
Yeah, by now the investors would be used to it. It's been a bit of a volatile ride for them. Obviously, it attracted quite a bit of interest when it initially listed because its technologies feed into and underpin the clean energy transition. They produce the fuel cells for power generation and electrolyzers, which are used in green hydrogen. Uh, but as with the technologies themselves, interest has peaked and then waned somewhat. And at the moment, the outlook for green energy is open to question. The results themselves, again, I guess they reflect this. There was they downgraded guidance for full year revenues, brought that down to £32 million, which is well down on the early estimates. They blame the shortfall on timing issues in relation to a new manufacturing license agreement, which, as usual, presents something of a dilemma in terms of revenue recognition. But obviously, they've taken a prudential line on there on that, which is good from a investment perspective, I guess. There was a adjusted loss in terms of EBITDA of £11 million against a loss of £9 million in the prior year as well. The gross margin pulled back, but more importantly, the operating costs decreased through the period, and that had an impact on the related margin as well, which the company itself will be happy about. I did have a look as well at trading volumes through the year as well, because it always pays to look at that rather than just the share price trajectory too. And they seem to have peaked and troughed from the beginning of the year through the middle, and there's been a bit of renewed interest lately. I don't think it has much to do with the financial performance at the half-year mark, but certain developments themselves. One of the problems at the beginning of the year as well, that they had a joint venture agreement with Bosch, which was cancelled, and Bosch itself has a 17% shareholding in the company, which they said they were going to let go. I did have a look at the FactSet update on that, and they still seem to be holding at the moment. But that obviously had quite a negative effect on the share price performance. I guess, in a sense, it points to a problem with a company like Ceres, is that you're always going to have this risk linked to over concentration in terms of the contract. This is a joint venture, obviously, but they deal with some high-profile clients and partners, if you like, but it's a small pool, and that increases risks.
Yeah. It has been, as we said, very up and down this year. I said more down than up, but if you take a 6-month view, the shares are actually up 180%, recovering that ground from the Bosch announcement, the termination of that strategic partnership, but only recovering, which does tell you how far the shares fell during that time. Bosch is holding as well. As you say, there's a bit of an overhang there. It was actually just this morning we got a stock exchange announcement just showing it's gone down a little bit more from just over 14 to just under 13%. And Bosch have said they're going to cut it gradually, as you would expect them to say, but there's clearly still some way to go on that, because I don't think they intend to hold much of that at all in time. The company, it does have, though, other potential outlets. It does have other deals. It is still pre-profitability, and that profitability has been pushed out further because of this revenue recognition for the full year not coming through. It does have a deal with Doosan in South Korea, which is, I think, an area of particular focus now, where it's using its fuel cell technology to really try and prove the case for other companies to take up the same technology. This is the solid oxide fuel cell technology, which Doosan is using. The question which some people are asking now, or maybe the case for renewed optimism is kind of, to an extent, pinned on whether this technology can be used for data centers and AI. So they've kind of shifted from the big green energy interest to the big AI interest in some ways. So that might be something they can use in future, it's fair to say.
The Doosan agreement, I think the actual production there kicked off in July. But beyond that, I'm not quite sure what the first phase, when that's going to end and when they're going to assess what's been happening. Ceres did mention in the interim update that they're intent on switching to a commercially focused business model. No doubt that the Doosan arrangement informs that decision, because in the past they've obviously had to allocate a proportionately large amount of capital in terms of R&D. The trouble is, in terms of profitability itself, outside the joint venture, because Bosch have moved away from that, you're going to see capital demands probably increase proportionally. We didn't have any indication of that, but just logic tends to dictate that, I think. In terms of the data centers themselves, I mean, that's obviously that's a really positive potential area for Ceres, but it's worth pointing out that I wouldn't necessarily they have first mover advantage in this regard either, even though their technology has been around for a little while now. But when you look at companies in that space, such as Equinix, which we recently covered in Taking Stock as well, other companies, the big hitters like Google and Meta are involved. In Asia, China Telecom and AWS too. So they're moving into a fairly crowded marketplace. I mean, presumably the Doosan agreement will firm up the technical viability of Ceres products as well. And who's to say they won't be able to sell into those markets? Some of the bigger players there. I guess that's the hope of management.
Yeah, I think the hope certainly for Ceres is what you're driving at there is that these big data center customers, such as the big tech giants, will use their technology in the data centers. But there too, as you're implying, there are competitors. Bloom Energy is one in the US, which has some data center deals already that does this fuel cell or provides them to data centers, and that's a far bigger company. So muscling in on that market will be tricky. But that said, if data centers do continue to grow and the number of data centers increases, then there will be more opportunities for companies. And it does seem, from my perhaps limited understanding, that this fuel cell technology could be particularly useful in the way data centers are used, and some of the outputs from that as well could help with things like cooling too. So there's potential there. In the meantime, the company, the good news at least, is that its balance sheet is strong enough for now, for the next, 1 or 2 years, a couple of years perhaps, it looks like. They're not in a shape where they need to immediately go and get more funding at the moment.
No, not looking at the cash burn itself. They've got just over, at the interim cutoff date, they just had over 100 million in cash, half of which is in short-term money markets at the moment. And they had a net cash inflow through the year as well. Presumably, as they're looking at operating costs now, there's a chance that will be supported going forward. So, the capital demands in the short term, it's not such an issue itself.
Yeah, it's tough with a company like this to discuss valuation, isn't it, really, given its pre-profitability? But clearly what people will be looking for is evidence of more deals, more licensing agreements coming through. Progress with the Doosan partnership should be able to do that. But as ever with a early stage technology, there are still questions over whether that happens, but that's the decision investors must make, really.
Yeah, I guess when I looked at the valuation at the half-year mark, I didn't throw my hands up in there, but it is just very difficult to get some type of relative feel about it, because looking at, I identified a couple of other players in the market of similar size and with similar technological offering as well. But the best I could come up with is that it's now trading at about a 40% discount to the consensus target rate as well. It's got coverage for about 8 investment houses, and the price to book is about 2.5 times, which certainly isn't extravagant for what might be termed a tech stock. So I can certainly see the interest there, but it all comes down to the narrative, I'm afraid.
Yeah, there are more agreements it has in place. Delta Electronics is one where there's certainly some agreements in place there. So it's not just Doosan, and Bosch wasn't the only one, but it is still a small number of customers. And I mean, it's always been an interesting company, and it'll probably remain that way. But we'll see how far it manages to progress in the months and years ahead.